So obviously, most of you guys are familiar with income taxes, and you know what are income taxes because you wouldn't have been this far if you are not sure about income taxes. So income taxes or income tax. So basically, we are looking at IAS12. Let me just do this. Okay, great. So we are looking at IAS12. So the main question that you have is what IAS12 is actually about. So here we are talking about the big idea. So we are talking of the big idea. Now, most importantly, IAS12 makes you show the tax effect of transactions in the same place. In the same place you showed that transaction. Right. So that's essentially IAS12. But now let me just explain what this means. Right. So let me explain to you guys what this means. Um, actually, now I know this might be challenging for you, especially this sentence as it is just there. Now, I have a quick question for you guys. I want you guys to elaborate on what you think this particular question is all about, or this particular statement is all about. So I want you guys to elaborate on that. So I'm going to give you guys just 1 minute to put your ideas into the chat box. What you think this particular statement is saying. Because of now, I just want you guys to put the statement into your own words before I explain it. So please attempt that in the chat box. Okay, we've already gotten one response. I'd appreciate if I get responses from the two others also. Okay, so in essence, you guys are correct, right? So what you guys are saying in the chat box shows how tax impacts the transaction. And we also have another statement saying it means comparing tax law and accounting principles. You're almost there. It shows how tax affects accounting. Yes, correct. So now, basically, what this statement is saying is that if the underlying item is in profit or loss, the tax effect goes to P&L. Now, second place, if the underlying item is in OCI, so basically in this case, the tax effect goes to OCI. Now, in the third place, if the underlying item is recorded in equity, so this definitely means that tax effect goes to equity. So now, IAS12 deals with two taxes. So that's the most important thing that you need to know about IAS12, which is income tax. So IAS12 deals with two taxes. So the first one would be current tax. So basically, yeah, we are talking about the tax payable or refundable for the current, sorry about that. So the tax payable or refundable for the current year based on taxable profit per tax law. Right. Now, we also have B, which is the deferred tax. So we have B, which is the deferred tax. Tax consequences. So those are the tax consequences in the future because the accounting values. So when I am talking about the accounting values, I am in essence talking about what the carrying amount, right? So, and tax values. So when I'm talking about the tax values, I am in essence talking about the tax bases. So are different today. So this is deferred tax. And now, these differences are called temporary differences. Right. So now, this is the current tax and deferred tax. Obviously, I am going to elaborate on this current tax and deferred tax because of with your current tax, the key thing that you're being tested on is calculating the current tax. So that's the key thing that you're being tested on. So since we noticed that's the key point that you guys are being tested on, I am going to give you guys a way on how to calculate the current tax. Right. So now current tax. So here I am talking about our calculation flow. So our calculation flow. So now what you're going to do is that you're going to start with your, let me write it. Start with accounting profit. So start with your accounting profit and adjust to get taxable profit. Right. So now, if you were to attempt to tell me what would be our calculation flow, what would be our methodology that we will be using to calculate our current tax. So in the chat box, please attempt to tell me what would be the methodology to calculate our current tax, or the methodology that we will use to calculate our current tax. Okay, so I am now looking at your attempts. So I will put the profit before tax, add or less deductible or taxable items, less movement of deferred tax, and multiply by the tax rate. Correct. Adjust for the temporary and non-temporary differences after accounting profit before tax. Great. So now, basically what we are going to do, we are going to have our accounting profit which is the accounting profit before, or the profit before tax, right? So this will be in reference to IFRS. So now you are going to add or subtract permanent differences. So now those permanent differences, they are permanent in their nature. So there's not going to be a time where you're going to reverse them, right? And then you're going to add or subtract your temporary differences. Now, these are due to timing differences. So they will reverse in future. And all in all, you're going to get a taxable profit. And this will be the taxable profit in terms of the tax law. Now, you are then going to multiply the tax rate. Then after multiplying with the tax rate, let me do this. So you're going to multiply with the tax rate. And then the answer that you are going to get will be your current tax expense or payable. So this will be what? This will be your current tax calculation flow, right? So since now I am talking about permanent differences, temporary differences, it will be fair for me to explain them. So now, when we take a look at permanent differences, so here we are talking about items that affect accounting profit, but never affect the taxable profit. Right. So, and this will not be anywhere near the future. So we also have examples. So examples, we have non-deductible fines, right? So non-deductible fines are permanent differences. So examples would be maybe some donations not allowed, as well as exempt income. Then we also have temporary difference. So now, here we are talking about items So we are talking about items that affect accounting profit. So they affect accounting profit now, but the tax effect happens. The tax effect happens in another period. Right. So it's only fair for me to also give the example here as well. Now, with the example, here we are talking about different depreciation rates. So tax versus accounting. So obviously it would be depreciation versus wear and tear. And we also have provisions. So with provisions, what you normally do in accounting is that you are going to expense now, but you are going to tax when paid. Right. So this would obviously be what? Your prepaid expenses. No, we also have our prepaid expenses. Sorry about that. Now, when doing your entry for this current tax, when you are doing your journal entry, so what you're going to do is that you're going to debit income tax and you're going to credit current tax payable. So now, obviously, if SARS already paid provisional tax, you'll obviously net it off against the payable, right? So now we move to the other part, which is the deferred tax. Now, deferred tax, here we are talking of, or here we are talking about, so deferred tax. In this case, we are talking about the heart of IAS12. We are talking about the heart of IAS12, which is deferred tax. Now, the central question for us would be why deferred tax exists. So, it's a key question that we have to ask ourselves. Why does deferred tax exist? Very important question. Now, if we are to answer that, it would be due to the fact that deferred tax matches tax to the period in which the related income or expense is recognized. Right. So obviously this would be in IFRS. Right. So this would be the case. This would be the case even if SARS collects or pays later. Right. So that would be the case. Now, if we go into context. So now, deferred tax is based on the balance sheet approach in most cases, and that's the most practical one that you'll be using in 90% of the cases, right? It is based on the balance sheet approach. Now, basically, balance sheet approach or your statement of financial position approach. So, basically, yeah, balance sheet, statement of financial position approach. So what we are going to do is that we are going to look at every asset and liability. We're going to look at every asset, liability, and compare. So what you're going to compare is the carrying amount. So carrying amount is IFRS, like you are using accounting, right? Your carrying amount in terms of IFRS versus your tax base. So this would be your tax value. And then the difference that you get will be your temporary difference. Now, temporary difference multiplied by the tax rate. So which will give you the deferred tax. Right. So, but it will start making more clarity or making more sense when we do the particular question. Right. So I'm just looking at the chat box. So deferred tax exists because of tax principles and accounting principles differ. Yes, in essence, that's what we are talking about, right? So now, since you hear me a lot talking about carrying amount, tax base, etc., it will be fair to give the applicable definitions. So when I am talking about my carrying amount, so when I am talking about my carrying amount, so yeah, basically it is the amount of an asset or liability in the statement of financial position. So under IFRS, right? So this is our carrying amount, right? Now, tax base. So now with regards to tax base, so asset tax base amount that will be deductible against taxable economic benefits in future when the asset is recovered. Then we are going to have a liability tax base. So here we are talking about the carrying amount minus any amount deductible in future for tax purposes. Right. So this is the tax base of an asset, and this is the tax base of a liability. So I've also mentioned temporary differences. Right. Temporary differences. So now it would be fair for me to do this on the side. So temporary differences. So now temporary differences. Yeah, we are talking about the carrying amount less tax base. Then what we are going to do, we are going to classify, right? So in essence, what I want us to achieve is taxable versus deductible temporary differences. Remember, all this falls under the big heading deferred tax. Remember, there are two types of taxes, which is the current tax and the deferred tax. So everything falls in those particular two, which is not an issue, right? But now, I firstly want to elaborate on, let me label it A. I firstly want to elaborate on the taxable temporary difference. So that's something that I want to elaborate on first, right? So, yeah, when we are talking about taxable temporary differences, this taxable temporary differences are going to result in a deferred tax liability. Right. Now, what does this mean? Right. So, this means when the asset is recovered, right, the liability is settled, right? So, in essence, it will create, so in essence, it will create taxable amount, so taxable amount in the future, right? So, in simple terms, what we are trying to say here, is that more tax later. We are going to have more tax later, right? So obviously, for you to get your deferred tax liability, you are going to take your taxable temporary differences and then you multiply by the applicable tax rate, right? So now, how this is triggered when you are doing your deferred tax in terms of the statement of financial position approach, right? So this triggers the following, right? So accounting carrying amount of, so the accounting carrying amount. So obviously the carrying amount is from accounting, but I just need to elaborate it. So the accounting carrying amount of an asset, when it is greater than the tax base, right? So this could be the case where accounting depreciation, is lower than the tax wear and tear, right? So this will result into a taxable temporary difference. And then we have perhaps the liability. So the liability tax base. So liability tax base is greater than the carrying amount. So it is less common but possible, right? You would also get your deferred tax liability. Now, we also have B. Now, B, we are taking off deductible temporary difference. Right. So these ones are going to create a deferred tax asset. So now, what does this mean in essence? Right. So basically, let me just remove the bolt. So this means when the asset is recovered, so when the asset is recovered and the liability is settled, it will create deductions in the future. Right. So basically, what does this mean? It means that you're going to have less tax later. Right. Now, another important thing that you should think of, and it will always be provided in your scenario. So this one, the deferred tax asset, right? You only recognize a deferred tax asset if it is probable that future taxable profit will be available to use it.
Sorry, James. Can you hear me?
Yes, I can.
I just want to find out when you say only recognize a deferred tax asset if it is probable that future taxable profits will be available to use it, how do you know when it's probable?
Okay. So um for answering your question, there's going to be a statement where they tell you in the scenario that this entity has sufficient future taxable profit, right? That will be available in use. So when we do practical questions, I will highlight this statement for you. So it's normally provided. It's either in additional information somewhere there, right? But I will show you.
Okay, thank you. I always wondered how to do this part. I think this is where I get confused. I don't think I noticed it in the scenario.
Okay, no problem. We'll see it. Okay, so now it's also fair for me in this particular case to provide common triggers. So yeah, the common triggers would be when the accounting, so this is the case that often happens. So the carrying amount of an asset is less than the tax base. So that's a key one. Or when the liability tax base is less than the carrying amount. So now, this was just a theoretical explanation. Obviously, there is a short way to memorize or a shortcut in memorizing everything. But I will show it to you guys later. Right. So now, the most important thing is that when you're dealing with asset, right? So when the carrying amount of an asset is greater than a tax base, you are going to get a deferred tax liability, meaning that more taxable profit later when recovered. So when the carrying amount of an asset is less than the tax base, you are going to get a deferred tax asset. So meaning that more deductions later when recovered. Then what liabilities? So liabilities, I can even switch it around, but it's fine. When the liability tax base is greater than the carrying amount, you are going to have a deferred tax liability. And yeah, when the liability tax base is less than the carrying amount, you're going to have a deferred tax asset. All right. So now I want us to do a quick example. So example 1. So we are going to start off with example. Now, example 1, let's say we have a machine which costs 1 million. Number 2, the accounting appreciation on a straight line is over 5 years. So there is no residual in this particular scenario. We have tax, wear, and tear at 40% per annum on the reducing balance. And then, no. What I want us to calculate is, or rather, what I want us to do is to do the income tax expense journal. So this is what I want you guys to attempt. So please attempt this journal in the chat box. So I want you guys to attempt that. It's not difficult. It's not difficult as such. So basically, the best way to approach this right. So remember we are at end of year 1. So at end of, let me just use a different color. So at end of year 1. So we are going to have an accounting carrying amount of, obviously now we have 1 million, less depreciation. Obviously, if it's 5 years with no residual, it would be 1 million divided by 5. So this would be less 200,000. Because of million divided by 5, we get 200,000. So meaning at the end of year 1, we have an accounting carrying amount of 800,000. Now, for the purpose of a tax base, for the purposes of tax base, we need to calculate 40% for wear and tear. So meaning that we are going to take the million less the wear and tear. So this would be 40% multiplied by 1 million. So giving us 600,000. All right, because of this would be 400,000. A million less 400,000 would be 600,000. So then what's going to happen? So it's going to be easier for us now. So now what we are going to do, we are going to calculate the temporary difference. So obviously the temporary difference is 200,000. Remember, to get your temporary difference, you're going to take your carrying amount less the tax base. Right. So basically, we're going to take 800,000 less 600,000, giving us 200,000. So now, remember, we are dealing with an asset. Remember our rules. So now, because it's an asset and the carrying amount is greater than the tax base, it means we are going to have a taxable temporary difference, giving us a deferred tax liability. Right. So now, let's calculate our deferred tax. So our deferred taxes, we are going to take 200,000 multiplied by 27%, as that's our tax rate. So we are going to have, please calculate that amount in the chat box. All I know is that we are dealing with a deferred tax liability. So the answer that we are going to get a deferred tax liability. So please calculate that. So in the chat box, we get 54,000. Now, when we are to generalize, if you are dealing with a liability, you know that, okay, it means that I'm going to debit my income tax expense with 54,000. It is an expense which increased, expenses increases on the debit side. So then we are going to credit a liability because of liabilities increase on the credit side. So deferred tax liability, 54,000. So now, basically, yeah, tax has given you extra deductions early. So it means that the future taxable profit will be higher. All right. Now, any questions on this before I move to example 2? Okay, so now I want us to move to example 2. Let me just check. Okay, I think example 2 will do it over here. Because of income taxes are not that difficult. You will see when we start doing the statement of financial position approach, it's very much easier to do, right? So they look difficult at first, but now once you master this theory, or not master, understand this theory, and when we move to the practical examples, after the second practical, or after the second question that we do, you are going to be perfect. So now, example 2. What we are going to have is, maybe I want us to deal with a provision for warranty. Right. So now, the facts that we have, right, is that the warranty, we just do this. So the warranty provision, so the warranty provision recognized at year end is 300,000. So now, tax allows deduction only when paid, right? So currently, there is no tax deduction, right? So now, we have a tax rate of 27%. So we need to assume it is probable the company will have taxable profit. Right. Okay. So now, first thing that we are going to do, right? Remember, also the same case. Let me just copy what I want us to do as the required. So also in this particular case, we need to attempt the income tax journal at end of year 1. So the first thing that we are going to do is that we are going to determine tax base of a liability. Right. So obviously it is for a provision liability. And they'll have a provision in your test. You're going to get a provision obviously when you are writing a test about income taxes or deferred tax, right? So here we have a carrying amount of 300,000. We have future tax deductions, obviously, when settled, right, of 300,000. So what does this mean to us? Or what does this say to us? So basically, the tax base is equal. The tax base of this particular liability would be, tax base would be the carrying amount less the future deductible amount. Right. So in this particular case, tax base would be 300,000 less 100,000, which is going to give us 0. This is going to be our tax base. Okay. Now, what we are then going to do is we are going to calculate our temporary difference. right? So as we note previously, as we mentioned, right, temporary difference is equal to carrying amount less our tax base. So in essence, what's going to happen that we are going to take 100,000 minus 0, which is our tax base, carrying amount less tax base, giving us 300,000. So now, since we are dealing with a liability, so for a liability, the carrying amount is greater than the tax base, so which gives us a deductible temporary difference. Therefore, resulting in a deferred tax asset. Right. So now let's calculate our deferred tax. So since we know that we are dealing with a deferred tax asset, we will take the 300,000 multiplied by the applicable tax rate of 27% and get, can someone please calculate the answer for me in the chat box? So I'd appreciate you calculating that amount. Okay, so now we have 81,000, right? So remember, our main objective is to do what? Is to perform a journal, right? So this is an asset. Asset increases on the debit side. So what we are going to do, we are going to debit deferred tax asset at 81,000. And then we are going to credit what? Our income tax expense. So we are going to credit our income tax expense at 81,000. So now, what now are we aiming to achieve by this example, right? So the most important thing is that the accounting recognized an expense now, but tax will allow later. So meaning that there's a future deduction, a future tax saving. That's why it is a deferred tax asset. Now, let's move over to example 3. So example 3. Here, I want us to look at the revaluation. So here, I want us to look at the revaluation of land. So our effect, the first one, land carrying amount increases by revaluation surplus, right? So of 2 million. And then tax base of land remains the cost. So basically here we are dealing with no tax deduction until the sale, right? So basically, if you think of this, the tax base is unchanged and we have a tax rate of 27%. So now let's think of this. What would be our temporary difference? Remember, the main goal is also to do a journal, right? So when we look at the temporary difference that we have, right? So now, just to give you guys overview, is that revaluation increases the carrying amount. However, the tax base stays the same. Therefore, the carrying amount being greater than the tax base will result in a taxable temporary difference, which creates a deferred tax liability. Right. So our deferred tax liability would be the 2 million multiplied by 27%. So what do we get in our calculators? So I want you guys to tell me what amount you guys are getting in your calculators, or on your calculators rather. Okay. Everyone is agreeing to an amount of 450,000, not 45,000. I mean 540,000, sorry. Okay. So this is a liability, right? Now, the trick part comes here. So we are not going to debit income tax. We are going to debit OCI. Obviously, the contra account will be a revaluation surplus, right, of 540,000. Now, what we are then going to credit is the deferred tax liability. Because of it's a liability increases, or a liability increases on the credit side. That's why we have it as a credit. Now, the key thing that I can tell you about this example 3 is that, of course, the gain was in OCI. The deferred tax also goes to OCI. That's the key thing, right? Now, there is a point where students get it wrong. So there's some things, or something that I need to make you guys be aware of. So, and this is a point where a lot of students get wrong, or get it wrong. So now, here we are dealing with recognition exceptions. So recognition exceptions. So here, this is the place where students often lose marks. So now, if we look at initial recognition exemptions, so, and just to take note, this is highly tested, right? So you do not recognize deferred tax on initial recognition, right? So you do not recognize deferred tax on initial recognition. of an asset or liability. So obviously this would be in the case or in a transaction that firstly is not a business combination and at the time of the transaction. So at the time of the transaction, it affects neither accounting profit or taxable profit. So now, let me just give a common example that is being used. So, common example. So this is the common example that you will be faced with. So now, you are buying an asset where accounting carrying amount equals cost and tax base equals cost. Right. So now, there is no temporary differences anyhow. Now, but if I am to elaborate on this example, right, it's going to confuse you guys a bit. So, but the tricky test case, right? So often with leases, right? So leases can create differences on day one, right? So obviously depending on the tax rules, right? So now, do not let this confuse you a lot, right? But the most important thing is that where you are buying an asset where the carrying amount equals the cost and the tax base equals the cost, there won't be any temporary differences. Now, another important one where we are not going to recognize is goodwill, right? So goodwill, you let me remove the bolt. So you do not recognize deferred tax on initial recognition of goodwill, right? So deferred tax liability on goodwill is prohibited. So it is prohibited under IAS12. It's prohibited. Now, another case that you might get, it is with regards to investment or investment in subsidiaries, maybe associate or joint ventures, right? So also in this particular case, you do not. So these are the exceptions. As much as this will be an asset investment, what happens is that the deferred tax liability is going to be recognized on the deferred tax liability is going to be recognized on taxable temporary differences, right? So this would be the case of unless the entity can control the reversal, right? And obviously, it is probable the difference won't reverse in the foreseeable future, right? So now, let me just continue further. But don't let this confuse you, right? Don't let this confuse you. This is very high level, the rate. It's very high level, and don't let it confuse you, right? So let me just do this. I just want to shift. So don't let that confuse you. It is the only high level cases that you'd find. But goodwill is not high level, right? You need to know it. Now, let's go back to what you will see on your day-to-day when dealing with income tax. Okay, so now, obviously, when you are measuring deferred tax, you are going to use the expected tax rate, right? So now, obviously, when you present your income tax in the P&L, you are going to present it based on your current tax expense and your deferred tax movement, right? So basically, what I'm saying is that income tax expense, the expense in your P&L, so the expense in your P&L. So what you're going to do in profit or loss, you typically show the following. So in your profit or loss, we are going to typically show the following. So you are going to show your income tax expense, which will be your current tax expense, plus or minus your deferred tax movement, right? So now, obviously, when we are talking about your current tax expense, we are talking about your tax on your taxable profit for the year. So let me just write it for those who need clarity. Your current tax expense will be your tax on taxable profit for the year. And then obviously your deferred tax movement will be the change in opening to closing balances. Okay, so now we also have what we call a tax rate reconciliation. So we also have what we call a tax rate reconciliation. Now, IAS12, particular standard that we are dealing with. So IAS12 requires a reconciliation between the following. Right? So it requires a reconciliation between the accounting profit multiplied by the tax rate and the actual and what the actual tax expense. So now let's do a mini example. So let's do a mini example of this tax rate recon. So here we have our facts. So we have our facts here and are saving our facts. We have an accounting profit before tax. So at $1 million. So you have our accounting profit before tax at $1 million. We have our tax rate at 27%. So in essence, when we talk about our theoretical tax, so when we look at our theoretical tax, it would be sitting at 270,000. So let's say we have permanent. So let's say we have permanent differences, and the first one would be non-deductible fines sitting at 50,000. And obviously now these are going to increase tax, right? And then we also have our tax exempt interest, which is sitting at 20,000. And obviously now this is going to decrease tax, right? So now, something that you can take note of is that temporary differences. Okay, let me just do this. Let me write it here. So let me deal with this issue about temporary differences, since they might be a question. So temporary differences do not explain the difference in the total tax expense versus the theoretical tax, right? But can still affect the current tax in the year. So we don't really care about them, right? So now let me just put this in red. So now we are going to start with reconciling. Remember, this is the tax rate record. So obviously, if you are to have a reconciliation idea that you need to attend. So let's say you are to have a reconciliation idea. So you are going to start, let me just remove the bold. So you are going to start with 270,000. Right. Okay, what are you going to do? So we have the 270,000. That would be our starting point. Right. So in the chat box, what are you going to do? What are you going to do? Please let me know. What are you going to do? The information given. So I want you guys to tell me what are you going to do with the information given. Remember now, we have the non-deductible fines of 50,000. So we are going to take the 50,000, which is the, and let me just do this. So we have the non-deductible fines. So this non-deductible fines, 50,000. We are going to multiply it with the tax rate. So when we do the tax rate recon, we the tax rate. So can someone please multiply this for me? As well as we are going to take into account our tax exempt interest. Right. So we are going to take this 20,000 multiplied by 27%. And what the amount that I'm getting in the chat box? So I get 18,500 and I get 5,400. I mean 18,500 and 5,400. Okay, so now since I have that, so this is going to increase our tax. Remember, increase our tax. And this is our tax. This is our theoretical tax. If it's going to increase, you are going to add. And this is going to decrease. We need to subtract. So, meaning that our expected tax expense would be 278,100. Now, here's a teaching point that I want you guys, or a knowledge point that I want you guys to grasp in relation to permanent differences. I told you about temporary difference. Now I want you to tell you about permanent differences. So, now, permanent differences change the effective rate. So, temporary differences mostly change the split between current and fair. not the long run rate, but it's fine like this. Right. So it is just something contrary to the temporary differences. Because of temporary differences do not explain the difference in the total tax expense versus the theoretical tax. But obviously they still affect the current tax in that particular year. Now permanent differences, they change the effective rate. So temporary differences mostly change the split between the current and the effect. Right. So now um if I am to give you guys a summary of what we have just done today, right? So it's fair for me to give you guys a quick summary of what we can, of what you need to remember from today's class, right? Is the following. So, quick summary. So it's just a short summary. So now, current tax. So current tax is the tax on the taxable profit for the year. Then deferred tax is the tax effect of temporary differences. Right? So here I'm talking about the carrying amount. This is the tax piece. And then with regards to asset, right? If the carrying amount is greater than the tax base, you get a deferred tax liability. If the carrying amount is less than the tax base, you get deferred tax asset. Simple. Now, with the case of liability where the carrying amount is greater than the tax base, you get the deferred tax asset. In the cases where the carrying amount is lower than the tax base, you get a deferred tax liability. Right. Great. So now you also need to recall the match location. Right. So the matching of location. So P&L items. Right. So P&L items will be text coding or will have a text that comes from P&L. Then OCI items will have a text that comes from OCI. Right. Now, this is just a quick summary of something that I want you to grasp. Because of this relate directly to what we have done today. Remember, what we have dealt with today is income tax, right? So IAS12. We dealt that IAS12 has two types of taxes. Income tax has two types of taxes, which is your current and your deferred tax. We have given the calculation flow of how to get your current tax, right? And we have explained the difference between the permanent and the temporary differences and how you would do a journal entry. We have mentioned deferred tax. We have discussed what is the carrying amount, what is the tax base, what's the tax base of an asset, what's the tax base of a liability. Right, great. And then obviously we have explained temporary differences. You get the taxable temporary differences, you also get a deductible temporary differences. We have elaborated between the two. And we only mentioned that you only recognize a deferred tax asset if it is probable that future taxable profits will be available to use or when they will be available to use. We have went through three examples elaborating or explaining what we have dealt with. and I've given you the recognition exemptions, which are very high level. The most important one that you need to remember is that goodwill. You do not recognize, this part is the most important one and the common one in terms of this recognition exemptions. You do not recognize deferred tax on initial recognition of goodwill. Right. Very important. And we have the income tax expense, how you would present it in the statement of profit or loss. It would be your current tax expense plus minus your deferred tax movement. So we have explained what would compromise your current tax, which is the tax on the taxable profit for the year. We had explained how you'd get the deferred tax movement, which will be the difference between your opening and closing balance. We have touched the tax rate recon and how you do it. And the most important thing with the tax rate recon, it focuses on the permanent differences, right? You get your theoretical tax based on your accounting profit, which is the 270. And then you are going to adjust for permanent differences. But it's not limited to that. We will get more detail as we do the questions. And we have just done a mini example of how you would do a recon, right? So, and below is a quick summary. So I think there's something in the chat box. So will I share this document with you guys? So I'm definitely going to just create this note in a more presentable PowerPoint presentation slide, right? Because of this was just my rough work for the purpose of explanation. So I'm going to create slides for you based on what we have done today, right? So now, any further questions? Any further questions that you have for me? Remember that you are more than welcome to contact me also. You are more than welcome to contact me as well. So if you need any information, please text, right? So nonetheless, this brings us to the end of our class. I hope you guys enjoyed. Good night.